Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Today's our webinar's title is Dividend Investing versus Growth Investing, which is more suitable for you. So my name is Shen Chu. I'm the moderator for today's webinar. So welcome everybody. I'm sure many of you here, we have your own preferred strategies when it comes to investing in the stock market. Some of you here would favor capital gain, or some of you here would favor steady dividend income. So today, our speaker will share with you the differences between both strategies and to try to explore and see which strategies is more suitable for which type of investor. So without further ado, let's get started. All right. So disclaimers is whatever we share today is only for educational purpose. So in no way they give any recommendation for you to buy or sell any securities should we mention here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce our speaker, and he is Ian Tai. So Ian Tai is the content producer for kclau.com. He has personally written more than 100 articles, financial planning articles on kclau.com. He's also a weekly webinar host and presenter on the kclau.com. As a co-founder of Dividend Vault, he manufactures savvy investor who can build dividend-based portfolios independently. Okay, he himself is a dividend investor. He primarily invests for dividend income, and his yield is ranging in between 2 to 8% per annum. So that's a little bit about our speaker today, and he is also author of 3 books. All right. So without further ado, let me hand over the session to you, Ian. Welcome to the program, Ian.
Yes. Hi, Shane. All right. Once again, I would like to say thank you for your very kind introduction. And of course, I would like to say that I'm actually quite grateful for LifeChamp, for organizing this webinar. And it's always a pleasure to be here doing a webinar session with Bursa Malaysia. So I have actually prepared something for you guys. It's less technical, but it's more philosophical. So without further ado, let's get started, because
all right,
this can get a little bit heavy today. So today we are going to talk about dividend investing versus growth investing. But before we actually explore the differences between the two, let me just start off by asking this question lah. All right. So I think these two questions are questions that we need to address first before we actually talk about dividend versus growth. So the two very important questions that I would like to first address will be this. The first one is what is the definition of investing? And the next question is, are you an investor? All right. So these two are actually very important. Why do I say so? This is because I would like to actually impart some food for thought for all of you here today. Is because I mean to say, imagine this. Let's say, for example, you go on a coffee session. All right. Maybe you go out with a lunch with your colleagues. Maybe you come home, you talk about stocks with your family, okay? And let's say, for example, you have a conversation like this, all right, about stocks and whatnot. The thing is that the people that we talk to, right, let's say they say they have actually invested in some stocks, all right? So we have a conversation and they reveal to us or to you that they have actually invested into some stocks. The thing is that these people, right, all right, so for myself, what I will do is that when they say they invested in some stocks, I may tend to see how they actually think, all right? How they actually think, what's their thought process behind their investment. So that is actually something that I personally like to do. And from there, I actually found out that actually not everyone who says that, oh, I bought into some stock, or they say that they have invested into some stock, right? They are actually investing, or he is actually an investor. All right. So it's as what I've actually written on the slide here. A person who buys stocks, all right, or if you find any person who buys any stock, that doesn't necessarily mean that he is investing or he is an investor. Okay. Now over here, I'm going to just first and foremost introduce to you guys, I'm going to give you a short overview of the stock market and the three main types of retail investors lah. Usually we say retail investors, but then the thing is that let me just change this retail investors into retail buyers lah of shares in the stock market. Okay. Oh, before I go into that, very importantly is that just now when I talk about the conversation, right? So here, what I would like to say is that when it comes to buying shares, it's very important to actually, how do we actually know that this person is truly an investor? Whether or not is he really investing when he buys the stock? Actually, how we define this, right, is actually based on two things. The first one is actually his motive, and the second one is actually to understand his thought process or the processes that he uses in order to buy his stocks. Okay, so the motive, right, it could be, we have to actually see, okay, what is his motive? Is he just trading for gains, or is he one who is genuinely wanting to actually own the share? All right, so that is actually the motive. When it comes to processes, right, it actually depends on how he actually, what kind of process, what's his logic, what is his justification for buying his shares. Okay, so this is actually the two things that I will look at when it comes to defining whether or not a person is an investor or not: the motive and the process. Okay, now here, let me just move on by giving you an overview of who are the main, who I think are the main types of stock buyers in the stock market. So basically there are three types. The first one is actually the speculator. The second type is actually the trader. And the third one is the investor. So we have the speculator, the trader, and the investor. Okay. So perhaps today I mean to say, maybe some of you come in, I'm not too sure whether you are fresh in the stock market or whether you are experienced participant in the stock market. But for personally, right, I felt that it's very important for me to actually differentiate between the three different types of stock buyers. Okay, between if I find one who is a speculator, so I'll say, okay, so that guy is a speculator. If that guy is trading, then I say, okay, so that is him. He is a trader. And last but not least, if he is investing, then he is an investor. All right. So this kind of compartmentalization to me is actually very important, simply because I would like to avoid this kind of questions. Like, for example, there may be questions like this. Okay, so let's say, for example, people know me as an investor. So the next question they will ask is that, do I trade? All right. So say, Ian, I heard that you're an investor. Do you trade? So the answer is no. All right. And likewise, the next question that comes in is that, is trading investing? All right. So people who do not compartmentalize this, right, who do not know how to differentiate these two, will tend to think that investing is actually trading, and people who will think that people who are trading stocks, right, are actually investing. So that's the problem here. All right. And the issue actually comes in even worse when we kind of like gel the two together. Like, for example, someone may introduce himself as an investor and trader. So it's like, I'm an investor and trader. Oh, what does it mean? Actually, what does it mean that he's an investor and trader? So that actually makes the whole confusion even more confused. So therefore, in this segment, right, I would like to just spend a little bit of time to demyth or debunk this whole thing, right? And guys, if you are listening, right, what I would like to say is that we have to compartmentalize this three, speculator, trader, and investor. Now let me just share with you what is the psyche behind these three. Yeah. So the first one, let's look into speculator. So speculator, as we know, all right. So basically, right, they come into the stock market, maybe into Bursa Malaysia, right? Actually, they don't have any sort of investment plan or investment skill. Basically, right, they will just treat stocks like, a fun trip to Genting casinos lah. So maybe Raya is coming. So who knows? For those of you who are not celebrating Raya, maybe you will go to Genting. So it's that kind of feeling, all right. So it's all based on the thrill, luck, and some sort of fun, that's how speculators approach the stock market. Okay, it's all about luck and greed. So what they will do is that actually what they're seeking is actually, maybe they are expecting some kind of windfall or some kind of, some lucky money or fortunate money or something like that. So when it comes to them, they will buy stocks with the intention to, they buy and then they will try to sell it at the quickest possible amount of time. And maybe from there, hopefully they will get a gain. Otherwise, they seem, for most of them, maybe they seem to be okay of losing that kind of money. So that is actually from the speculators' mindset. Nothing serious. It's all just pure luck and pure fun. Okay, so that's speculator. Now let's move on to trader. Now trader is actually kind of like a little bit more serious, simply because they are more willing to actually spend the time to actually study the charts. So a study of charts is actually known as technical analysis, whereby they will try to learn how to use certain technical tools, to actually they are trying to predict or trying to time the market. They are trying to predict when exactly a stock price is at the lowest, and then maybe they find it to make sense to actually enter the market and buy some of these shares in hope that they can actually sell it at the trading gains or trading profit, they call it. All right. So the difference between a speculator and trader is that while their motive seems to be the same, is to buy and sell, and they seem to don't have a very long term view about a certain stock. All right. And they seem to they try to buy at a certain price and try to sell it at a higher price. But speculator go in with a gambling mindset. Trader go in, maybe they are aided with some charts and technical analysis too. So that is actually traders. That's what I think of them. And last but not least, let's look at investors. Now, when it comes to investors, these are the few words that are very important to us. Number one, when we come into the stock market, right, whenever we buy shares, we are genuinely interested in business ownership. Means to say we are not so focused about whether this stock will go up or come down. What we are interested in is the business. So therefore, we will assess the productivity of the business. And when we assess the productivity of the business, we hope that the business can produce long-term recurring income. All right, long-term recurring income. So that that is actually how we intend to gain. So whenever we buy a share, what we want is not just the capital gains or losses, but what we want is a long-term steady flow of income, all right, that comes into our pocket. So if it comes into our pocket, that will be dividends. If let's say the income increases over time, maybe the business will revalue itself, and therefore that is how capital growth happens, all right. So for the investor, what we are more interested to get into is the business. Okay. For speculators and traders, they are more interested in the short-term trading gains, right? So that is actually the differences between the three. Now let's look at the mental picture of a speculator and a trader. All right. So here's how it works. So for speculators and traders, speculators, they are just there for fun, and traders, they use technical analysis too. So what happened is that they're interested to buy a stock like this. So for example, let's say they found out that this is actually the price they are willing to pay to actually come in and buy the stock. It is okay. Sometimes it may seem that buy low, sell high, right? But most of the time, right, it's not really buy low, sell high. It's just they can also buy high and sell higher one. So it doesn't matter where they buy. So whatever price they buy, they just want to sell it at a higher price. Okay. So the whole idea about speculator and trader, right, is to it's their whole motive, right, is very simple. Is to buy to sell it at a higher price. So the outcome is this. Sometimes it will meet their expectation. They will get a trading gain out of this trade. Sometimes it may not work out to their expectations, so therefore they may have trading losses. So what happened is that for speculator and trader, right, their whole focus is always on the stock price because they are very price sensitive. And in general, like typically, right, speculators and traders, they only come in, I mean to say they will buy into a certain stock. Not too sure what is their basis, but they'll just buy because there is a belief that the stock price will just go up. It can be anything, anything that justifies their belief. It can be a good news, it can be the GDP, it can be a positive outcome of the election results, it can be the interest rate, it can be many things. All right. As long as they think that the stock can go up, they will buy. And of course, likewise, the reverse is also true. What kept them from coming into the stock market to buy, right, can also be all these news and rumors, you know. So let's say, for example, the election outcome is not towards their expectation, or maybe the interest rate it fluctuates in such a way that it's not towards their expectation. Okay, or maybe the ringgit Malaysia has weakened, or maybe some other things that comes up, you know, and this kind of thing, right, will deter them from actually coming into the market. All right. So therefore, when that thing happens, then of course, maybe they are more inclined to sell off the stock because they are very price sensitive and very news sensitive kind of people. So that is actually speculator and as well as traders. All right. So here is actually a diagram. Here is actually a stock price chart. And what happened is that this is how they may do their trading or make their transaction. Okay. So what happened is that if let's say they use technical analysis to what they hope to do is that, okay, so let's say we have a stock price that grows up like this. So speculators and traders, what they hope to do is this. So you see the price here is a bit low, so they will try to buy here. And then when the stock price peak over here, they sell. And then of course the stock price drop here. Hopefully they are smart enough to buy here. And then the stock price goes up. All right. And here it reaches another peak, then they will try to sell. And then it will drop back. And then over here at this low point here, they try to buy. And then they will hold until they hit the high point and then they try to sell. All right. So basically what speculators and traders try to do is very simple. All right, which is they try to find out where is the lowest point or where they think that they could actually come in, and then they buy. Then and then it will hit the peak. So if it hits the peak, the highest point, they try to sell, and hopefully they can do that successfully. Okay, so that is actually what they hope to do. But of course, it's easier said than done. All right, for most of the time. Nobody gets it 100% correctly done all the time. All right. And if you ask me, is this what investors do? No. All right. So if you ask me, do I know how to do this? Buy at the lowest point, sell at the highest point, buy back the same stock at the lowest point and sell back at the highest point? The answer is no. I do not know how to do all these kind of things. All right. I do not know how to predict this kind of price. Sorry, guys. I have no crystal ball. All right. Rather, I would say that from an investor point of view, right, this is actually what is more pertinent to us. Okay, so this is how our mental picture looks like. So when we look into a stock, we are basically looking into a business. And when we make an investment, so let's say this is one transaction, right? One transaction to actually buy the stock. And what we are more concerned about is that whether or not this business, right, can generate recurring income. All right, as you can see, it's one investment, but then the thing is that the income stream, right, is multiple income, multi-years, multi-quarter or multi-years of income. The income must be recurring, and hopefully the income must actually increase over time. All right. And when a business can actually consistently grow their income over the long term, we kind of like just want to hold on to this stock for the rest of our life. All right. So the motive why we come in, right, is to buy and hold without selling for the long term. Okay, so as long as the golden goose keeps on laying the golden egg, we will not like how I say, we will not sacrifice the golden goose, right, in order to have a duck meat lah. All right, we are just happy and contented that the golden goose can keep on laying the golden egg lah. We are not too hard up for the roast duck or for the roast geese for the time being lah. Okay. Now, of course, it doesn't mean that we will not sell. All right, it depends on why we sell also lah. Okay, the two main reasons why we sell is that, number one, if let's say the business that we buy happens to deteriorate in terms of business performance, maybe the sales has weakened, maybe the profits have weakened, the fundamentals have changed in certain ways, maybe there's an industrial shift or something like that, then maybe if it's business sense, is business wise to sell, then we will sell it. And number two is that sometimes, I don't know lah, okay, but these things happened to me before. I buy into a business, all right, the business generates recurring income, but some trader and some speculator somehow find favor in the stock, and then they try to goreng lah, they try to speculate, and they spike up the stock price of my stock to a certain level, and it doesn't make sense anymore lah, it doesn't. And then the way the stock goes up, right, it doesn't justify lah, why the stock price just shoot up like that lah. So when that happens, congratulations lah, time to jump off the boat lah, because some speculator and trader, they are willing to buy your shares at such a lofty kind of a price, just sell off lah, So that is actually the two main reasons why. That is actually probably the best reason why I will sell off the stock lah. All right. So that's actually the case lah. So as you can see, it's the same. So this price chart over here and this price chart over here is basically the same price chart. But for investors, right, what we love to do is this. So we love to say at the lowest point, all right, actually the better idea is that as long as the stock remains undervalued, we will continue to buy, we will hold, and our mission, our objective is to accumulate for the long term. All right, so as you can see here, it's just buy. All right, so there may be a price drop over here, price drop over here, price drop over here. Doesn't mean that we will sell lah, we will just keep on buying as long as the price is undervalued. Okay, and because our game is not to get trading gains, our objective is to accumulate. All right, accumulate for the long term. So for this webinar, right, we are not going to talk about speculator. We are not going to talk about traders. All right, so these two group of people, they are not my focus for today. Today, I will be focusing on investors, all right, whereby we are talking about business ownership, productivity, long-term income, and the income must be recurring, all right? And so we are talking about not just recurring income, but the sustainability of it, the longevity of it, all right? So this kind of stuff that is actually the focus for investors, all right? So today we're going to talk about investors. Now, when it comes to investing, all right, basically when we talk about investors, commonly speaking, we will say that in the world of investors, or in the world of investing, everyone is actually quite, in general, practicing the principles of value investing. Okay, value investing, which is the art of accumulating shares of good businesses at undervalued prices for the long term. Now, from this family of value investors, there are now two different groups of people. Okay, the first group of people are known as dividend investors. The first group of people are dividend investors. The second group of people are growth investors. Okay, so dividend investors, growth investors, both of them are actually subsets of value investors. Okay, we're in the same family, just two different styles of investing. Okay. Now, of course, in this webinar, I'm going to review to you the differences between the two. But in order to do that, I must first actually explain the similarities behind growth and dividend investing, or dividend versus growth, or dividend and growth investing. So let's get into it. Now let's talk about the similarities. So as mentioned, both of them, dividend and growth investing, they are all subsets. All right, they are all under the same family or the same umbrella of value investing. Now, their similarities are as follows. Number one, let's talk about their motive. So both of them, they are interested to buy to keep. Okay, buy to hold or buy to keep. And they are more interested to accumulate. Okay, accumulate. So now let's say, for example, you go out with your friends and say, oh, I just got myself into a growth stock. Say, really? Growth stock? So how long, then you just ask them a question. How long do you intend to actually hold on to the stock? Maybe they will say, you know, I'm just going to hold on to it for maybe 1 year or 2 years. Then, you know, very likely, right, this guy that you talk to is not exactly investing. He could be a speculator if he's there for fun, or if you find that his thought process is not like, you know, he's not an investor kind of stuff. He doesn't read annual reports and stuff like that. He's just not too sure. Maybe someone told him about the stock and then he buy. So if he's that's speculator. Maybe he used some charts to actually help him to find the stock, and he believes that it will go up in 1 or 2 years time. So he buy. Then you know that he's a trader. All right. But typically speaking, for growth investors, they also buy to keep one. All right. Both dividend investors and growth investors, they buy to keep. Simple. All right. Now, when it comes to their holding period, it's always forever, right? All right. It's always long-term forever. Now, when it comes to their process of how do they actually come out, how do they justify this stock purchase, right? They will always look at these two things. Number one, the fundamentals. So the fundamentals here simply means that both of them, growth and dividend investors, they will look at the earnings of the company and the cash flow of the company, and both of them wants their company to actually deliver consistent growth in their earnings and cash flow. Operating cash flow here, all right? So what I'm referring to is operating cash flow. Earnings and operating cash flow, both of them must grow. Okay, so that's the fundamental part. And then both of them, they also use valuation, all right? They also value their stock, because under the umbrella of value investors, right? Nobody wants to overpay for their stock one, okay? Nobody wants to overpay for their stock. So therefore, they will calculate valuation ratio. So both of them will use PE ratio and dividend yields. Of course, there are other derivative kind of valuation ratios. Like for example, we use the PEG ratio, which is PE ratio divided by growth. All right, so they will compare PE ratio and growth. So that one is a derivation. But in general practice, usually for most growth and dividend-based investors, they will use PE ratio and dividend yields. Last but not least, when it comes to their gains, both of them will actually, it's good to have dividends, one, okay? It's just that the degree of importance is a bit different. Of course, for dividend investors, they will prioritize the dividend income. For growth investors, they're just happy to get some dividends, okay? It's not their priority, but hey, if a stock gives you dividends, why not? Just collect the dividends. But when it comes to capital appreciation, they want the capital appreciation, right? They believe that the capital appreciation is business-backed. It is actually kind of like justifiable by the stock's business results. What do you mean by justifiable by business results? It's like, for example, let's say you hold on to a stock for 10 years, okay? And in that 10 years period, right, the stock kind of like grow its businesses. All right. So initially they just, let's say for example, we are talking about manufacturing plant. So let's say the stock has 5 factories. After 10 years of doing business, it grows from 5 factories to 10 factories, for instance, okay? And as a result of it, the stock has generated more revenue, more profits, more cash flow, pay out more dividends. So therefore, the valuation of the stock or the valuation of the company should actually go up to reflect the growth in the business. So that's what I talk about business-backed capital appreciation. Okay, not the kind that is fueled by some trader or some speculator. All right, not the kind of capital appreciation. If it's speculator or trader fueled, let me say speculator and trader just suddenly they found your stock to be very favorable. They just want to hype up the stock, or they try to like goreng the stock up. Usually that one is not so sustainable because they're always short-term. If there are short-term people, the reason why they buy is very short-term. The reason why they sell is also very short-term. So that's why it's not so sustainable. Okay, so make sure that the capital appreciation for investors, what we want is business-backed capital appreciation. Now, let's talk about the key differences. The key difference between, actually, there's one key difference between dividend and growth investing. Okay, now let's talk about the difference. So here, there's a slight accounting that we are going to go through together. So to actually illustrate the difference, the key difference between dividend and growth investing. So we have dividend stock over here, and then we have growth stock. So what is similar is this, okay? Revenue minus costs and taxes. So both companies, the similarities between the two is both of them must be profitable. Okay, see here, 10 million, 10 million. Both of them profitable. Now, the difference lies in how the company chooses to use the profits. Okay, so the common ground, the similarity between the two is both must be profitable. The difference between the two is how they use the profit. So for dividend stocks, as you can see here, 10 million, 8 million payout to shareholders as dividends. Okay. So therefore, if they pay out 8 million out of the 10 million as dividends, what happened to the 2 million? The 2 million, they just keep it within the company, and the company is free to use the 2 million to reinvest, to use the money to reinvest back into the business and grow the business. Okay. So that is dividend stocks. For growth stock, on the other hand, what they will prefer to do is to pay the shareholders less amount of dividends out of their profit. They choose to retain more of their profit in their own bank account so that they can use the money reinvest back into their businesses and grow their assets, customer base, grow their reach, and get more profits. All right. So let me just reiterate once again. For dividend stocks, all right, the difference is, all right, the profits, more of the profits pay out as dividends to shareholders, less money for reinvestment. For growth stock, lesser of the profits to dividends, more of the profits back into reinvestment. So that is actually the key differences between the two. All right. All right, so as we can see here, the key difference, just keep this simple diagram in mind. For dividend investors, for dividend stocks, most of the profits pay out as dividend. For growth stocks, most of the profit reinvestment. Okay, reinvestment. Now, so knowing this difference, so the next question will be this: how to be successful in both dividend and growth investing? Okay, so how do you actually become a good either one, dividend investing or dividend? How do you be good in dividend investing, or how do you be good in growth investing? Or usually now if you see the differences, actually, most of the people, right, they can be quite balanced when it comes to dividend and growth. All right. Why do I say so? Because if I look back, right, okay, so we have dividend stocks paying more proportion of dividends out as more portion of the profits out as dividends, lesser for reinvestment. But actually, right, there are some stocks, all right, they kind of like 50-50, you know, all right, 10 million, 5 million will be out as dividends, another 5 million for reinvestment. There are some stocks like that. So it kind of like balance out dividends and growth. Also got, okay, also this kind of stock also exists, all right? So you can actually play around with the two, all right? But of course, for me, honestly speaking, I tend to have a higher ratio when it comes to dividends lah. That's just one style of doing it lah. But I would say that there are some of my friends, they are more into the growth part lah. All right. So it depends on what style. Both can actually play out really good. Okay. So it's just a matter of preference. Now let's talk about how to be successful in dividend and growth investing. Now, so basically, right, in order to be good in both styles of investing, right, we have to see that they are similar in some ways, but then when it comes to assessment of the fundamentals of the stock, it can be a little bit different, all right? Now, let's start off with dividend stocks. Okay, so this is how I would assess a dividend stock. So basically, I would download the annual reports from Bursa Malaysia. And what I would like to find out is this. Okay, if let's say the stock has a 10-year track record, I will want to know its sales, earnings, and operating cash flow. So these three must grow. Okay, so the stock must deliver consistent growth in sales, earnings, and operating cash flow. When it comes to its balance sheet, hopefully it is conservatively financed with low debt, lots of cash. All right. So the balance sheet must be very healthy, low debt, a lot of cash, very good. Okay. And so this is actually how I will assess dividend stocks. Now, if you look at the growth stocks, actually I would, if I'm looking at a growth, if I'm looking at a stock for growth, I will also be looking at sales, earnings, operating cash flow. All three things must grow. Balance sheet also, hopefully it must be conservatively financed. Low debt, a lot of cash. As you can see, both are the same, more or less the same. Now, when it comes to valuation, both also use PE ratio and dividend yield. So initially, in a glance, it doesn't seem like there's any differences. However, now we come to the difference. Now, however, when it comes to dividend stocks, let's take a look at the difference. If I'm looking for a stock for dividends, typically the first thing that I will check is actually the cash flow statement. All right. So both of them must have operating cash flow. Remember, operating cash flow must be consistently positive, and better still if it continues to increase year after year. So OCF stands for operating cash flow. It must continue to grow. Now, the thing about dividend stock is this. The operating cash flow, they will use most of it to pay out dividends. Okay? Most of the operating cash flow, dividends. That's for dividend stock. Okay? When it comes to growth stock, a lot of operating cash flow will go into capital expenditure. Okay? Capital expenditure. Okay, this could mean that the stock actually go and buy new property, new plant, new equipment for business growth. Okay, so CapEx. So when you actually look into a growth stock, as a growth investor, what is very pertinent is this. Because the company has a lot of cash flow, and they are willing to actually invest a lot of this cash flow into CapEx. So the key thing here is to find out what exactly is the growth initiative of the stock. What is their business plan? what is their latest initiative to develop the business so that they can sustain or so that they can actually continue to expand and grow into the future, right? Because why? If let's say, for example, they have the cash flow, technically speaking, right, they could have, just sit back, chill, relax, and just, do what the dividend stock do, take the cash flow and pay us as dividends. But then the thing is that if I'm going to invest something in for growth, I am actually going to forfeit my right as a shareholder to collect these dividends. So what I would like to know as an investor is that if I forfeit this right, as a company, all right, the management or the board of directors, what on earth, what are they going to do with that money to actually further expand the company so that the company's valuation will actually go up in the future? So that is something that I would like to find out as a growth investor. So if I'm actually looking into that, what I will do is that I will read the chairman's statements and I will actually track the business growth and expansion. All right. So how do I do that? Chairman's statements, you can find it in the annual report. And I will actually look at the corporate announcement, which is also a part where you can actually find it at Bursa Malaysia. It's all free information. Just go to Bursa Malaysia and find out their corporate announcement, find out their business plan, find out their, their latest announcement. What are they doing? Okay, you have to dig a little bit of information to actually assess whether or not you want to participate in the company's growth or not. Okay, so that is actually the tweak when it comes to assessing a growth stock. We want to find out the latest growth initiative of the company before we invest. Okay, now when it comes to valuation, very importantly for dividend stocks, we can actually just simply use the PE ratio and dividend yields. It's very simple, very straightforward. For growth stocks, although we use dividend yields and PE ratio, but we kind of like put a lot more weightage on the PE ratio, and we tend to put a little bit lesser emphasis on the dividend yields because the ultimate objective is to participate in the growth of the company, and much lesser when it comes to receiving dividends. So that is actually growth stock. All right. So as I mentioned, in practice, right, most of the fundamentally solid stocks, the ones that consistently delivered growth in sales, profits, and operating cash flow, right, these are all stocks that are flush with cash. Technically speaking, most of them are hybrids. Okay, they are all hybrids of dividends and growth kind of stock. Okay, and especially I'm speaking of this especially in the context of stocks listed in Malaysia. All right, where dividends, right, where dividend incomes are actually kind of like tax exempt, so that is actually, it's all single tiered kind of stuff, so basically it's good to actually receive dividends as an individual retail investor, so therefore most of the stocks in Malaysia can be a hybrid of dividends and growth. All right, so now the more important question is this: which of the two styles of investing would you prefer, dividends or growth, and why? Okay, so guys, let me just perhaps we can actually do a simple question. Perhaps you can actually type in the chat box. Maybe you can let me know which of the two styles do you prefer? Is it growth, or is it dividend, or is it the dividend investing style? And maybe you can also put in the reason why. So Shane, maybe we can monitor the response.
Sure.
Yep. So Shazila says dividend, Ronald dividend, Chua says half. Sharina, balanced portfolio. Okay. So Shane, how do you find it? A lot more dividend? Lesser growth?
I think 60% dividends, 40% growth lah.
60%.
Looks
okay.
like dividend investor is a bit more tonight.
Looks like dividend investor is a bit more tonight, huh?
Slightly more than growth a bit. Yeah, that's what I see lah.
Okay lah, fantastic. All right, guys. Let me just continue. Thank you so much for your feedback. Let's move on. Okay, so guys, let's say for example today you listen to my presentation and you say, hey, I'm actually kind of like undecided lah. Not too sure what to do with the two, right? So how should you decide? All right. So the question is, it depends on your current status lah, your current stage lah, as an investor. All right. How good are you? How experienced are you as an investor today? All right. So I mean to say, so here I will actually lay out a few scenarios lah. All right, a few situations, and maybe I will just share my thoughts, my views on this. Okay, so let's say for example today, if you are a beginner, you have no knowledge about stocks. Okay, you come in fresh, you are freshy. So which of the two styles is actually more suitable? So for me, right, here's what I think. All right, so if you are a beginner and you're kind of like exploring here and there, I would say that in Malaysia, in a Malaysian context, dividend investing, right, can be considered over growth. All right, not to say growth is bad. All right, growth is good. But as a beginner, all right, as a freshie, so the thing is that for beginners, all right, you may want to start off with dividend investing first. All right, not to say it's the best strategy in the world, but it's because most of the dividend stocks in Malaysia, the ones that can continuously pay increasing amount of dividends, most of these stocks are much easier to be studied. Why are they easier to be studied? It's simply because most of these stocks, right, their financial reports are simpler and they are less complicated lah. All right, they are less complicated. Okay, less complicated. So it's very easy to study them because their financial accounts are simple, easy to understand. Okay, you will know at the first glance whether these companies are profitable or not profitable. Very easy to study one. Okay, and by doing dividend investing, right, as a beginner, what you can aim for is that you can aim to collect your first few dividends, maybe your first ringgit in dividend income. Okay, so when you collect your first few dividend income, okay, at least cash is coming into your bank account. You can consider that as a success, and that kind of success, right, although it's small, all right, it can be small, it can be big, but let's say it's just your first few dividend income, your first success, right? At least it builds your confidence, you know. All right. At least you say, hey, I invest in the stock and then the stock actually kind of like pay me some dividends, right? Then you feel a little bit more confident, you know. Then you are more willing to you're more willing to continue on the process of the journey as a value investor for a much longer period of time, right? Because got the confidence, right? If let's say you start off by trading or speculating, and if let's say you kind of like got burned, then of course the feeling is not that great, you know, because who likes to get burned, all right? But of course, if I may add, those people, I mean, if you are fresh and then you want to speculate, and then you somehow speculate and you got some short windfall, okay, a little bit of windfall. Actually, that kind of people I also worried for. I also worry for people like that, not because they got the windfall, no. I mean, but it's because like you know, like people who go to Genting Highlands, they go and gamble and then they start winning some money. It can go into people's head, you know. So it can go into people's head, and then they think that they are invincible, okay, or their decision is right, it can be a bit dangerous, let's put it that way. All right, so let's move on. Now, if let's say you just want to focus on building a Malaysian portfolio, you just want to invest in a local stock, which is more suitable? Is it dividend investing or is it growth investing? Maybe you can type in the chat box and let me know. But as you do that, let me just share my views. What if, let's say today you want to invest only in Malaysia? Okay, so basically, right, both also can one. Okay, if let's say you want to invest for dividends, right? Dividends are like tax exempt, because after people actually kind of like, because it's like we have in accounting, we have profit before tax, then the companies have to pay corporate tax, and then after that we have profit after tax. Then the profit after tax, from there they'll pay us a dividend, and the dividend, right, is already like, because already the taxes are already paid at the corporate level. So as a individual, right, you're just collecting the dividends, all right. So it's already after tax kind of stuff. So it's very good. So the income is actually pretty good. So you can actually use dividend investing. Now, when it comes to growth, okay, when it comes to growth, it depends. Okay, it depends on what you are looking at. Okay, never have this illusion thinking that growth stock is a stock that has grown in price. Okay, grow in price is like, oh, you see certain stock, oh, some tech stock or what just grow in price. They say, oh, that must be a growth stock, because why? The stock has actually grown in price. That is not that is actually not exactly how you define a growth stock. Okay, that is just a stock that has experienced a growth in stock price. That's all. And this kind of stocks are very, very, I mean to say, it depends. You must actually evaluate whether or not this kind of growth in stock price, is it fueled by investors or is it fueled by all the traders and speculators? If it's actually fueled by all the traders and speculators, it's not something that I like to go into. Okay. All right. But here I would say that the dividend investing would be suitable for beginners. If you are looking to just focus on the Malaysian portfolio, there are many stocks in. I would say that Bursa Malaysia is not too bad. It's actually not too bad because of our tax structure. We have to be thankful that we are in Malaysia, where the tax structure is very favorable to dividend investors. And the only time that we will pay a little bit of tax, except for this, okay, if you buy a Malaysian REIT, there's a 10% withholding tax. But then the thing is that even that tax, right, the REITs, they will help you, they will pay off the tax, and then you will get the net, all right? You will get the net after paying off the withholding tax, okay? So don't worry, you don't have to declare this by yourself. The REIT, all right, the REIT will, the managers will help you to do all this kind of stuff, okay? But I would say that although in the slide I would say that dividend investing is suitable, but I won't discount the fact that you can also invest in growth companies, okay? Growth-based companies, all right? There are quite a few, but then it's an art form by itself to actually find this kind of stocks, all right? So therefore, if you are new, stick to dividend investing first, all right? Third situation, you want fast capital growth, and you want it in 1 or 2 years' time. So which of these two investing styles do you prefer? Okay, so let's say I don't know, maybe you have a friend who actually buys certain stock and then it actually increased by 50%, maybe 2x, 3x, I don't know, okay? He's getting very lucrative returns and he's telling the world that he is actually making really good money out of the stock. So the thing is that which of these two investing style is more suitable? So here's my take. So guys, investing is an activity that requires some patience. All right, really it's best to be patient when it comes to investing. So if you really want to get into something that you believe that can can give you a lot of returns at a very quick possible amount of time, I think the better thing is to not invest. All right. Please do not invest with a mindset of you are going to get super rich very quickly on Bursa Malaysia. That's not the whole. I mean to say you can invest in stocks and it is a good way to build wealth. But if you want quick and fast returns, right? Maybe investing is not the way. I don't know, maybe you can try speculating or trading, all right? But I won't say investing can actually give you that kind of glorious returns that you might be hoping for, okay? And the thing is that, how do I say, if let's say you wish to participate in the stock market because you love the excitement, you want some action, you see that certain stocks are going up already, and it's kind of like rational for you to actually like go in and participate, join the bandwagon, right? So if you are that kind of people, best not to invest, right? Because investing to me, I believe that it requires a lot of patience. Patience is very important. Okay. Now, the next scenario is this. What if today you listen to this webinar and right now you say, actually, I'm starting off with some capital, some investment capital, and your capital is any sum which is below 25,000 today. So which style of investing is, let's say you are now starting off with a capital of 10,000, 15,000, 20,000, 25,000. So the question is, which of these two styles are more suitable? Is it dividend or is it growth? All right. So capital below 25K. Now, here's the thing. All right. Just want to share with you a myth, okay, with people. Because sometimes I also receive a comment like this, all right? Like, for example, if you start off with a capital which you feel that is not so significant, right? The common myth is this: some people, they say they rationalize it this way. They say that because my capital is small, so I will trade stock first. I will try to trade stock so that I can 2x or 3x my capital very quickly. Then once my capital become larger, let's say 50,000 or 70,000, then I'll start to do value investing. All right. So you get the logic. So it's like if your capital is small, like 20K only, you try to 2x, 3x, 5x your capital to 100,000. Then once the capital is very big already, then you start to do value investing. So the question is that practical? Different people will have different opinions, but for me, I would say that if you have been trading for the longest period of time, if you start off with trading, right, usually it's very hard for you to stop trading and go into investing one. All right. This is because the thing is that if you are trading stocks, you have been looking at charts or you have been speculating for quick gains, it's very hard for you to switch that kind of mindset into the investing mindset. It's very difficult. Why? This is because both of them, they come from very different school of thoughts. So a lot of people, if they speculate, they're basically gambling. If you're trading, right, it's something like, of course there's an element of risk that's involved in this kind of stuff. But the thing is that for investing, right, especially for investors, we tend to be very risk averse, okay? So if you have been operating with a mindset where it's all about risk taking, high risk, high return, right, to actually build your capital, build your portfolio, high risk, high return to build a portfolio, right? It's a very different mindset, if you want to switch to the investor mindset, who is very conservative, kiasi, kiasu, and how do I say, very risk averse, it's a totally two different mindset. So the thing here is that it doesn't matter whether your capital is big or small. But what matters most is how you actually start off. So if you want to start off as a trader, then you start off as a trader and you'll be good in trading. All right. And how to be good in trading is something that I do not know because I'm not a trader. But if let's say you are starting off as an investor, then I will encourage you to actually keep on learning on how to become a better investor. And so that along the way, your experiences, right, will help you to be, your experiences, your education will help you to actually achieve much better returns from your investing activities at a much lower risk. All right. So if you start off as a trader, just trade. If you are looking to invest and that's your objective to invest, better you focus on investing. Okay. I would say that if you have that 25K, that low, I'm not to say low or what, because I also start off with very, very, very few capital only all right. I won't consider my one very big, but this is my path. All right. I can't say for all but let me just share with you my journey. Okay. So okay, I'll sidetrack a little bit here. Mazlan, you say, when do investors trade? Actually, investors don't trade. All right. Not for me. Remember, I compartmentalize everything. Like speculator is speculator, trader, investor. So I don't say, so as an investor myself, I don't trade. All right. And I don't think trading is investing. I split the two. It makes my life easier. All right. So that's my aim, because that's my end game. If you trade, you are there for short-term gains. If you invest, your objective is to accumulate. Okay. It's like if you buy into a stock, let's say Maybank. Okay. For a trader, they say, I buy at let's say $7, 7 ringgit. Now 9 ringgit. Should I sell? That's probably the trader mindset, Oh, 7 now, 9 now already 9. I think can sell already. Or should I hold it longer so that it will rise up to $10? So that's trader. So that's not me. But for investor, they say, okay, I buy now. Okay, so maybe I start off with 1,000 units. At the end of the 10 years, I hope that by certain age or by certain time frame, I will accumulate up to 10,000 units of Maybank, or maybe 20,000 units of Maybank, or maybe 100,000 units of Maybank, because as an investor, I want to accumulate. All right, and we kind of like want to do that kind of stuff, So we are accumulating kind of game. So from an investor point of view, I mean, personal sharing. So this is my path. So I kind of like started off with a lot lesser than 5K. I didn't trade. Typically speaking, right, I save, and usually, you work, you save, and then you start building your little portfolio gradually. All right. Of course, there will be dividend income coming in, but the thing is that it's more about the education and the experiences that is more pertinent. Then, of course, in order to grow my portfolio, then of course, the way is not to trade to get more wealth. The way for me, my path is to grow my active income, grow my you do all sorts of things like freelancing work, gig economy, or you kind of like do more businesses, get more sales and stuff like that. And then once you raise your income, your active income, then you use that money to actually fund your stock portfolio, fund your investment. All right. And of course, this is actually how I grow my portfolio. And even today, as I speak to you right now, I still continue the whole process and replicate the whole process today. It's just that, of course, looking back from today to the time before, of course, the quantum now is a bit different. But basically, it's generally that process lah. All right, that process. Okay, so if you are now fresh in the stock market, you're starting with not much capital, not to worry, because I also started off just like you. It's just a matter of putting in the right mindset, the right processes, and make sure that the system is good enough for you to actually make sure you have a good replicable system for you to actually slowly and gradually grow as an investor and grow your portfolio. Last but not least, let's talk about what if you are young or what if you're old today. Which one is more suitable? Should you trade? Should you do dividend investing or should you do growth investing? Which one is more suitable? Now, here's another common myth that I would like to discuss with you. Short one. Common myth. If you're young, focus on growth. If you're much older, switch to dividends. So if you are 20 years old, growth. If you're 60 years old, dividends. So is that practical? I don't know. So I wouldn't actually put a cap, like an age. Like if today you're 60-year-old, you should be doing dividends. Or if you're 20 years old, you best not to do dividends, best to go into growth. That's not the way that I look at things. Here I'll point out 4 things to be considered, all right, which may help us to actually decide better. The first one is that, can you actually handle short-term volatility? So let's say, for example, you're an old guy. Let's say you're old and then you have some money but then you kind of like retired. You don't have much income already. So the thing is that the thing you have to ask yourself is that, can you handle short-term volatility? Okay, so that is actually the first question. So if you can, then of course, maybe growth investing can be an option for you. Otherwise, maybe you can stick to some. Otherwise, I think maybe you can actually explore, because most of the dividend stocks tend to be a little bit boring, but boring is good. I love boring stuff in the stock market. All right, I love boring stuff in the stock market. Low, very not much volatility because nobody wants to talk about it, but we like to actually pick up gems like this lah. All right, as a dividend investor. So if that is the kind of thing, maybe you want to explore that. But if you like something, if you like to actually participate in the growth of a business, then of course can maybe. But then it will come a price which is the price of short-term volatility. That will happen. Okay. The second thing that needs to be considered is that are you still making regular active income? So if you're young and old, I mean to say, if you're still actively making income, the more income you make, then of course you can choose any one of the two. But the more active income you make, maybe growth could be an option. But if you have lesser income, dividend investing is very good because because it can actually pay some of your bills, which is not too bad. Like dividend investing has actually paid some of my bills, which is really awesome. Now, the third one is actually, of course, the ability to learn and master the art of investing. So if you're fresh, you do not have much knowledge about investing, then try out dividend first, because it's an easier skill to master. Once you have graduated from dividends, then you can actually upgrade yourself towards become a growth guy. All right. So that's the path. But if you don't want to go into growth, you say that dividend itself already, how do I say, 高价lah, means good enough to actually help you to actually get you the sustainable returns that you want, then just stick with dividends. But the final thing is that there's something that retirees should consider, all right? Because I mean to say, there's always an opportunity cost, right? So there's a choice for you to just keep your money in EPF, and there's a choice for you to do stock investing. But I would say that keeping your money in EPF, can be a good choice, because no cost, no nothing, still get your 6% dividends. Why not? Okay. Versus stock investing, which actually requires a little bit of education, a little bit of experience in order for you to get in. So if you are new, you have some savings, some cash savings. I mean to say the best to do is to start off a prototype portfolio, small scale, just for the education and experience. Learn the principles first. Once you are more experienced, then you can decide whether you want to add on to your investment. Otherwise, to just cash out from the EPF, which is already giving you the 5 or 6% dividends, and just blindly go into the stock market is not a wise move, I would say that. All right, so let me just conclude today's presentation, which is these 5 that I would like to impart to you today. The first one is this: not everyone who buys stocks are investors. Remember, there are 3 different types of stock buyers. Know who you are, know who they are. All right. There are speculators, traders, and investors. The worst thing that people can do is that if you are investing, you take up advices from a trader. If you are trading, the worst thing that you can do is to take an advice from an investor. So know the differences between the 2 or the 3, and then stick to the plan. Very important. Okay. If you're an investor, invest. If you're a trader, trader. If you are a speculator, have fun. All right. Now, the next thing is this: growth and dividends and growth investing are basically under the same family of value investors. It's actually the same. The only thing different between the 2 is that how you use the profits, all right? Because both styles of investing focuses on the profits of the company. It's just how you use the profits is something to be considered. Okay. Last but not least, I would like to encourage all of you to understand yourself and keep on learning to build a much more sustainable portfolios that are profitable. And with that, I would like to thank you for your time and pass back the control to Mr. Shane.
Thank you so much, Ian, for sharing with us, dividend investing versus growth investing, which is more suitable for you. If you have any questions you want to ask our speaker today, you may write your questions in the Q&A box, not the chat box. All right. If you write in the Q&A box, it's easier for me to moderate the session and pick your questions. Okay. Don't write in the chat box, because I see there are a lot of messages there I may overlook. Okay. The first question is, for growth stocks, right? What is the price to earnings ratio that you will consider them as growth stocks?
Oh, I don't have a...
Or what is the PE ratio that you would consider to buy in?
I won't give you a range because for me, my style is that I will look at the stocks track record, let's say for the past 10 years. I will calculate for every single year based on their closing price. I want to get the average of the 10 years first. All right. So different company will have different averages. All right. So the 10-year average, right? Then I will compare the current and the average. Then from there, I will decide.
Okay. Understand. Thank you so much, Ian.
All right.
The next question is, I'm looking at 20% annual return. So how would you advise people to build? What kind of portfolio should they build if they're looking at the expected 20% annual return?
Don't know. Please don't invest. Okay. Seriously, I mean to say, typically, right? I mean to say, don't focus so much on the returns, right? Because I believe that the more pertinent thing is that the sustainability is actually very important, all right? The business model is very important. The financial results are important. So I'm not too sure how do you classify annual return? Is it like today $1, 1 year later $1.20, or the next year $1.44, and then compound 20% per annum? Not too sure. I mean to say, you have to know your metrics of measuring your success. Then only from there you just decide . But of course, jokes aside, I mean to say, of course, just now, please don't invest is of course a joke . But then the thing is that what I'm saying here is that very, very, very severely is that don't focus so much on the returns. If you focus so much on the returns, the stock price drop, you'll feel very disappointed. Focus on the system, the process, and identify your key metrics of measurement first. then only we invest accordingly lah.
Okay, thank you, Ian. Would you be able to share some examples of which kind of stocks are dividend stocks, which kind of stocks are growth stocks? So this question is by Gunnar Segram.
All right. So Gunnar, right? The thing is that I mean to say most of the Malaysian stocks the thing is that I'm a bit hesitant to give you any, I mean to say some examples here and there lah, because scared that once I review already, then people go and buy, then not too good lah. But the thing is that you can do this, you don't need to actually look too far lah. I mean to say, just look at where you spend your money, right? Where you spend your money is usually a good place to find stocks lah. You know, you go to the supermarket, the best selling items are the ones lah. You know, the best seller items, just find out who manufactures this kind of product, who actually provides this kind of service, which company does that. All right, it could be a subsidiary of a listed company lah. Then all you need to do is just take the 10 years track record. From there you'll find them out already lah. I mean to say, that's quite obvious already. Yeah. Shane?
Okay. Stephen would like to ask, what is a good dividend payout ratio to consider it as a good dividend stock for investment?
Typically for dividends, I mean, okay, so for REIT is actually usually above 90% lah. All right. But any stock that is actually paying about anything above 70%, you can say that one is more for dividend-based investors lah. All right. But for growth, I think it would be about 20 to 30% lah. All right. Because if they pay out only 20-30%, which means to say they are also retaining about 70% to 80% of their profits back into their reinvestment. So you may want to know what is their latest initiative lah. So that's for growth investing.
Okay. The next question is by Chua. Is it advisable to reinvest the earnings, the dividend into shares?
Oh, it depends. For me, I love okay. So there's one good reason why dividends, right? Because let's say, for example, the company that you buy is a boring stock, but then it pays really consistent dividends. So now I receive the dividends, right? I got a lot of choice, on how I use the dividends. Like on one hand, one of the options, of course, to buy back the same stock that pay me the dividends. But the thing is that it depends on the price at the time lah. All right. So if it's undervalued, then okay lah. But if, let's say, for example, there are other better opportunities, then I can use the same dividends to buy stocks in other. I can actually buy other stocks. I can buy and participate into other businesses. So I can actually choose any of the two. And or alternatively, right, I can take the money and spend it on a chendol lah, or go on a holiday. That one is also open for discussion lah. I mean to say, so with dividends, right, you got to choose how you want to use your money.
Okay, thank you, Ian. The next question is, what is the recommended PE ratio and what are the ratios to look at before buying shares?
Oh, this one is like recommend. There's no range lah. I mean to say, but the thing is that don't go like, I mean to say, don't try to go with 40 or 50 or 60 or 100 lah. That's like, why do you want to pay for a stock that has a PE ratio of 40 or 50? Actually, right, if you look hard enough, right, you can find a lot of stocks that are where their PE ratio is reasonable lah. Some are at 10, some are at 15, some at 20. There's so many good stocks that are in that range really lah. So that would be good enough lah. But then the thing is that on a case by case basis, right, it depends on the stock lah. All right. So what I'll do is that the first and foremost thing is that the fundamentals must be right. If it has a good track record of 10 years, just compare the average and the current. Then from there, I will make a decision from there.
Okay. So the next question is by Chana. How do we look for, or what are things that we look for if you want to find an undervalued stocks?
It depends. Okay. Actually, we don't purposely go and find an undervalued stock. All right. We always want to find a good stock. Okay. Always the fundamentals of the stock, the business model must be right. because the whole idea is to be sustainable for the long term. So the business model must be right. Good business quality first. Then only we talk about the price. Okay. So when we talk about the price, then of course we can actually use the 10-year average and then you calculate the current. Then will tell you how undervalued or how overvalued the stock is already. Then from there you can actually decide whether or not you should get into the stock.
You mean you compare the 10-year price to earnings average
Yeah.
versus the trailing price to earnings
Versus
right?
the current versus the current. So give you
if the current is lower than the 10-year, you deem that it is undervalued. All right.
Most likely, yes.
Okay. So you focus on the business model, then we only evaluate the price.
Yes. If the business model is not right, then no point calculating valuation. After all, you're not interested in the business already, right?
Okay. So the next question is by Ming Yu. So will you sell as a dividend investor if you think that market is very likely to crash? Like, you see a lot of signals that, market is about to crash. Will you sell your shares or you just hold on for dividends?
I don't really think, because COVID-19 2020 has been an answer already, so the answer is no. I didn't sell any shares, and I didn't really think about I don't really time the market. I mean to say, I do not know when the stock market is going to crash. Maybe I have a gut feel, maybe the stock market is going to crash, but then I will not know. So my whole idea is to just buy whatever makes sense, and just hold it for the long term. Whether or not got market, because at the end of the day, I want it to be sustainable. Means to say the business must be profitable in both good and bad times. Economic booms and busts, whether or not market crash or market goes up. Doesn't matter which economic condition. I just hope that the businesses continue to be profitable. So for all those market crashes, right, maybe you leave it. I'll probably leave that to all the traders and speculators. But for me, I don't know one.
Okay. The next question is by Iflin. It's a bit more fundamental based in accounting. Okay. When the company do capex, right, will the retained earnings be deducted?
Retained earnings, actually retained earnings is under the balance, is under the, you can say, share equity or balance. I mean, okay, separate it. All right. Capex is capex will be reported under the cash flow statement. All right. The retained earnings part, right, will be under the balance sheet or the share or the statement of equity. So it's two different segments, two different places of where you get these figures. Okay. So I don't think it will. All right. In fact, you don't, I mean to say, no. Okay, the answer is really no, because these are reported in two different places.
All right. So with that, we would like to conclude the question and answer session right now. Seems time is running out. So thank you everybody for tuning in to today's webinar. Okay, let me share with you about what is Bursa Academy. All right. So Bursa Academy is a comprehensive one-stop e-learning platform that aims to provide you with a continuous and holistic learning journey. On Bursa Academy, there are a lot of investing resources that you can find, be it investing articles, videos, recordings, quiz, courseworks. So you can find a lot of resources there for you to understand more about investing strategies, product knowledge, and also the market. All right. So just visit www.bursaacademy.bursamarketplace.com or scan the QR code to take you to the website. Our next webinar is going to take place on the 9th of May, 2022. We will take 1 week break, okay, because of Raya. So yeah, we will see you after Raya. So for those of you who are celebrating, have a good Hari Raya festival. And for those of you who are not celebrating, then of course have a good holiday. So after the holiday, then we will see on this topic, which is 如何评估股票. Okay, how do we evaluate stocks. I noticed that just now there were a lot of questions who asked, now what are the PE ratio to look at, what are the the valuation metrics that we look at, what is considered undervalue. We will address that in detail in our next webinar that's happening on 9th of May. Like the title suggests, this session is going to be conducted in Mandarin. So I've given you the registration link in the chat box. So let me share with you again. So this is the registration link for those of you who want to deepen your knowledge in valuation. Then on the following Monday, next Monday after the Raya, we'll be looking at how do we evaluate stock. So if we know that different valuation method for different kind of stock, then we'll be able to pinpoint what are the which one is undervalued, which one is overvalued, and then you'll be able to help you to become a better investor. So we don't always buy into overvalued stock, but we only invest in undervalued stock. So that's what we're going to discuss in our next webinar happening on 9 May after the Raya. All right. So with that, I want to thank our speaker today, Mr. Ian Tai, for sharing with us about dividend investing versus growth investing, which is more suitable for you webinar. So thank you, Ian.
Yep. Thank you so much, Shane.
Yeah.
Pleasure.
Yeah. And thank you everyone for attending this session. Hope you all have a great holiday, great break next week, and see you all next time.
Selamat Raya.